Ari Rosenbaum I'm here with another fun-filled episode of that 401k podcast. This week's topic, we're going to talk about the headaches of employees in dealing with 401k plans. But of course, first things first, go to that 401ksite.com. Look up for information on our national virtual conference that will be in February for advisors, plan providers, and all that kind of stuff. Got some articles there and whatnot. I brought back my What Were They Thinking article, which is non-401k related and just kind of my 2 cents about all the kind of business and entertainment disasters. And I've always been a big fan of disasters and disaster movies, and there's always some things in life where you just know right off the bat, you just know it's going to fail. For example, I just wrote another article, blog post, which will premiere in a few weeks on Pink Lady and Jeff. You knew that was going to be a disaster from the get-go. And of course, go to Amazon.com. Got Kindle paperback versions of latest books, that 401k plan provider handbook, as well as Full Circle. So let's get to the topic at hand. I've always said it. I've never hired an employee once because I was an employee too. You know, it's always the joke about being the turd in the punch bowl, but there's that saying, it was David Geffen talking about Don Henley, and it was also a title in Full Circle of a chapter, and it was, you know, he's a malcontent, he'll always be a malcontent, and that's okay. And, you know, there were some people that just were never meant to be employees. I respect people. You know, I always throw Mike Webb a shout out. Mike Webb has been in his company for over 25 years, I want to say. I've known people in this business that have worked for the same company for over 20 years, and that's mad respect because that was never going to be me. Maybe if I worked for like a Fidelity or Capel Group or whatever it is, or Vanguard, maybe that would have happened. But I worked at smaller companies, and so many changes in the business. And, you know, the worst thing of all was you know, working for small employers. One in particular, you're commended about how much great work you did all year long, and then of course, as soon as you are eligible for a raise, that's when, you know, you're an awful employee and they should have fired you when they had the chance and all that kind of stuff. But, you know, when you're dealing with a sole proprietorship and there's no employees like I do, I don't have to worry about 401k plans and the issues that result from having employees. But there are a whole host of issues. Not to say that you shouldn't have employees. I'm just saying that the nature of the qualification of retirement plans requires a whole host of rules that you have to follow. And one of the biggest misconceptions out there is obviously who is an employee. We got the IRS and DOL, and they have different opinions. There's an assumption, obviously, that if someone issues a 1099 instead of a W-2, the worker is automatically excluded as a employee because they're considered an independent contractor. And that can be very expensive because sometimes the IRS can certainly look at the actual relationship between the business and the worker. And if the employer controls how the work is performed, when it is performed, where it is performed, and exercises significant authority over the worker's activities, the worker can be considered a common law employee of the employer. So calling somebody an independent contractor doesn't necessarily make them so. So I'd be very cautious to any plan sponsors thinking that if I issue everybody a 1099, then they're going to be an independent contractor. And one time when again, being a malcontent, I was always looking for the next job interview, and there was a TPA. I was the head attorney at one TPA, which was Geller Group. And my son was just born, I think. And there was a local TPA in Lynbrook. And they essentially were going to offer you the same amount of money. And I'm like, why would I take that position? Oh, well, you don't have to pay for the Long Island Railroad. And it was just like, you're nickel and diming me. And I think one time I suggested I'll be a 1099. then I could do whatever the heck I want to do with my money. If I want to put in a retirement plan, this, and that. And they said, no, we can't do that because of the IRS. Needless to say, this was the same TPA that always butted heads on IRS on some kind of trickery with special trusts within defined benefit plans. But that's neither here nor there. But, you know, one of the interesting things in professional wrestling is the WWE still to this day says that wrestlers are independent contractors, and until the IRS and or the Department of Labor say so, they're still considered independent contractors, except by their definition and how they are booked and their all their work. They are W-2 employees. They are employees for any type of definition, but until they're told otherwise, they're not. But sometimes employers view the independent contractor as a convenient way to obtain labor without the obligation associated with traditional employment, the pickup on the Social Security, obviously the 401k eligibility and all that stuff. And, many people forget that a worker that's improperly treated as an independent contractor may have been excluded from participating in the company's 401k plan. I don't want to deal with an IRS or audit, and all of a sudden they're like, well, these people are employees and you improperly excluded them. That's a headache, because not only would you have corrective contributions under the plan, there'd be payroll tax issues and whatnot. And the lesson here is simple. The retirement plan document doesn't determine whether someone is an employee. The law does. And if you want to do some trickery, be my guest, but you're going to have a whole host of problems, in my opinion, if you ever get audited by the IRS and or the DOL. Leased employees, and that's another headache. Many employers use the staffing organizations, PEOs, and all that stuff to obtain workers. And I understand the purpose behind it. It simplifies workforce management, but it can complicate retirement plan compliance. Under 414N, leased employees may be treated as employees of the recipient employer for certain retirement plan purposes. So this is a little bit shocking to a lot of business owners who assume that if they, get their employees from a leased organization, that it's off their books for retirement plan purposes. And it's a whole host of headaches. There are exceptions and special rules that hold money purchase plan thing that nobody does. But employers can't simply assume that leased employees are irrelevant for retirement plan purposes, and failure to consider leased employees can create a coverage problem for the testing of the plan, and obviously a coverage problem. The IRS and or the DOL says otherwise, that they were improperly excluded. Then, of course, there are the control group rules, and we know about those. For purposes of control group, if you are a control group, multiple companies are treated as one employer for purposes of coverage and all the other discrimination tests and whatnot for the plan purposes. And, business owners often operate multiple entities for a lot of reasons: liability protection, tax planning, or operational reasons. That's why, for example, a producing TPA may have three different companies: one to be the TPA, one to be the 316, and one to be the 338 or RIA. The problem, there may be separate payrolls and separate tax returns and all that kind of stuff, but for plan purposes, there may not be a respect for those distinctions. The control group rules require businesses under common ownership to be treated as a single employer. This means that employees of all control group members are going to be considered together as one for determining plan eligibility, coverage, and compliance. There's so many times in the past where I've had headaches dealing with plan sponsors that improperly excluded one company and it failed coverage. You have to ask the right questions. A lot of TPAs don't, because you're dealing with plan sponsors that may be a little evasive. The whole point of the control group rules is to make sure that you're not improperly excluding employees, because, again, I talk about the headaches of employees, but, dealing with employers who are cheap or, just want to... I did know some cheap guys, and they had... They I don't know how they got away with the coverage or affiliate service group rules, which we'll talk about later, but it's to avoid an abuse. That's the point of the control group rules, just like it's the point of the the affiliate service group rules, which are similar but kind of different because it's more facts and circumstances. I always joke that it was the reason behind the affiliate service group was doctors would employ nurses in a completely other staffing. They would split the cost of nurses, doctors, and defeat the control group rules because there was no 80% or 50% commonality or whatever it is. But the affiliate service group rules really affect mainly professional practices, like I said, doctor groups, law firms, accounting firms, all that kind of stuff. But affiliate service group rules aren't about ownership. They focus more on business relationships. Several businesses that work closely or provide services to one another may be treated as a single employer, even when that ownership rule is not identical. And it's a lot of confusion. I still do those affiliated and control group analysis. I still only charge $750 because I'm crazy and because I want the business and I want the relationship. But it's, you know, different. It's facts and circumstances. And, it creates a lot of confusion because many employers are completely unaware that affiliate service group rules exist. And that can be catastrophic if that error is detected. Then, of course, there are certainly eligibility errors that never seem to go away. Um, just because these are your employees, there's a problem of who is eligible to participate in the plan and when participation should begin. I just did that a few weeks back about eligibility rules, and it should be easy, but it's not. Obviously, having immediate entry is something that I don't like. I like immediate eligibility. I don't like immediate entry. I think we should have monthly entry at the very liberal part of it, of allowing as many people as you can have in. But, you have the problem of employees who satisfy the eligibility requirements but never receive enrollment materials or never offer the opportunity to participate. Sometimes that mistake occurs because of payroll coding error. Sometimes it occurs because someone misunderstood the plan's eligibility provisions. Sometimes it happens because nobody was paying attention. Regardless of the cause, the correction process is usually expensive and time-consuming. Then we have the added wrinkle of the long-term part-time employee change, and the Secure Act is now allowing long-time part-time employees who have more than 500 hours within 2 consecutive years to participate in the 401k deferral component of the plan. I'm actually in favor of it. It's just an added headache, an added thing that you have to catch. But employers really have to now track hours. Employers have to track hours of their part-time employees who may become eventually eligible. And, again, I like the idea of coverage. I don't like the idea that this is going to cause a lot of mistakes. But, of course, I make more money when there are more mistakes, I guess. I'm like the dentist. I've always compared myself to a dentist. It's like a dentist wants you to brush your teeth, avoid cavities, but, man, they make a killing with cavities and root canals. That's how my practice is. I want plans to operate functionally, and well, but I make a lot more money when they don't. So it's like a dentist. And that create the LTPT rule. We haven't seen it that much yet in terms of errors. I guarantee you we're going to see it, especially since it's a new rule. Of course, acquisitions bring new compliance headaches. When the company acquires another, retirement plan issues really become secondary concerns behind operations, customers, and financial integration. Believe me, I work for companies that got bought out. Unfortunately, retirement plan compliance doesn't take a break during acquisition. Acquired employees bring service histories, records, vesting, all that kind of stuff, benefits, rights, and features, protected benefits, all that stuff. There has to be determination whether the plans are going to remain separate, merge, or terminate. They must analyze control group issues, coverage testing concerns, and transition rules. Many compliance failures occur because retirement plan issues are addressed too late in the acquisition process. By the time someone examines the retirement plan implications, mistakes may have already occurred. And, again, big headache. And then, employees are necessary. Listen, I'm only gonna be as big as I can get because I don't have employees. I don't have, I don't want to bring out other ERISA attorneys out there, but they have other attorneys work on them, and they're more successful. And my hat's off to them. But I don't have the headache of dealing with employees. But the fact is, I don't think most employers are trying to violate retirement plan rules. It just happened that I work for these people. They are trying to run their businesses. The physician wants to treat their patients. The contractor wants to build their projects. The lawyer wants to sue people. Whatever it is, very few business owners spend their evenings studying the Internal Revenue Code sections 414B, 414C, 414M, and 414N to try to get one over on their employees. I don't think they try to do that. Nobody's a master criminal. Most employers are not. But these rules apply whether the employers understand them or not, and the complexity of retirement plan compliance increases dramatically once the employees enter the picture. Determining who is an employee, identifying leased employees, analyzing independent contractor relationships, evaluating control groups, affiliate service groups, all that kind of stuff. It's all part of a compliant retirement plan. I avoid these headaches. That's on me. And I got my own solo 401k plan. But, having no employee, like I said, limits growth. The challenge is recognizing that every employee relationship carries retirement plan consequences. Sometimes those employees are obvious. Sometimes they're lease employees, whatever it is. In the world of 401k plans, employee issues are often far more complicated than employers realize. And many of the most expensive retirement plan failures begin with a simple and costly assumption that someone was not really an employee in the first place. I mean, like I said, employees are headaches, but sometimes they're necessary headaches for a company to be widely successful. But employers have to recognize that there are so many complications. I'm not saying not to have employees. Again, that's what keeps most companies successful. But this is the obvious issues when dealing with 401k plans. So I hope you enjoyed this episode of that 401k podcast. Go to that401ksite.com. Information on the National Virtual Event. It's free to attend. Can be free to sponsor if you come in and help sponsor one of our live events. August is coming around the corner, and therefore we'll try to figure out where we're going to go to in 2027. And go to Amazon.com, Kindle paperback versions of our book, and tune in next week for another fun-filled episode of that 401k podcast. Take care. Bye.